We ready to go live?
Yes. I'm sorry. We broadcast these on our website now, so.
Okay. We're live.
Okay. Thank you, Sergio. Okay. Now let me call the meeting to order for the Investment Advisory Committee meeting for Thursday, February 25th, 11 o'clock. First item on the agenda is citizen communication input. We did not receive any. So we'll go to item number 2, consideration and possible action to approve the minutes of the November 18th, 2020 meeting. Has everybody had a chance to review the minutes?
Yes, sir. Move approval is published.
Is there a second?
Second.
Okay, all in favor signify by saying aye.
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 Any opposed? Motion carries. Review of economic outlook and performance. Eric, that's you.
All right, let me get this pulled up. One second.
You thought out already, right?
I'm sorry?
You thought out already? You're not
Yeah,
frozen anymore?
yeah, it's 80 degrees here, quite a change. Well, thank you. And so we'll be reviewing the market performance for the fourth quarter ending in 12/31/2020. And then we'll move on to the individual investments as offered in the 401A plan. Just to go ahead and get started. Can everybody see my screen okay?
Yes.
Great. So Q4 was another fantastic quarter as far as market returns are concerned. U.S. stock market up 14.6%, international and emerging markets also up significantly, and the U.S. bond market and global bond market also turning in positive returns there as well. A lot of this positive performance still kind of coming off of the end of the COVID kind of panic earlier in Q1. So a lot of this is, kind of coming back to previous levels, but certainly for some of the larger cap growth and technology companies, a lot of this, was certainly above new highs. I would say most indices right now, are certainly in the new high category, over the last Q4. So we can see here the performance across the board for asset classes, and then also the kind of where this quarter ranks as far as the average quarterly return. Obviously, this quarter returns significantly higher than the average quarterly return, as we continue to see strong performance across the board. World stock market performance, got some of the headlines there. For the most part, this has been kind of a slow and steady climb back up. Most of the volatility that we saw in Q1 is really not surfaced again in the last few quarters. So pretty quiet terms as far as the stock market, just kind of gradually making new highs. You do see some of the other larger headlines there as well. Housing markets continue to do pretty well. Certainly the low interest rate environment driving a lot of that. As far as world asset classes, we have some of the major indices. We can see here the top indice there, the Russell 2000 value. So that's going to be a small cap value index. So up 33%. A lot of that is a little bit of a mean reversion catching up to the larger growth companies. So the S&P 500 and certainly the Russell 1000 growth, both of those doing very well since COVID. And certainly there was starting to be a pretty large discrepancy between the returns of smaller value and larger growth. This last quarter started to, close that gap a little bit. You can see the S&P 500 only up 12%, which is still significant, but certainly lagging the smaller companies. As far as U.S. stocks, kind of a little bit about what I mentioned before, small value doing very well. Most of this is really kind of a mean reversion though. So if you look at the 1-year performance, as you can see on the table on the bottom right, you can see over the last year that despite turning in 33% over the last quarter, small value over the last year has still lagging larger growth, up 38% over the last year. But as you go further back to longer time periods, you can see certainly a little bit more similarity between small value, large growth, and large value. Next page, we have international. So international doing very well across the board for the quarter, up 19% for international value. But you can see really that's not done enough to kind of bring some of these indices back up to positive. So you can see, over the longer period of time, 1 and 3 years, most of these, still in the single digits, despite some pretty phenomenal performance in the last quarter. And then fixed income continues to be, low and steady for the past few quarters. So we can see here in the dark green line there in the top right, 12/31/2020. That's where we were at the end of the quarter for fourth quarter. And we can see how much that differs from the previous yield curve as indicated there by the light gray line, the 12/31/2019. So we do have a little bit more of a normal looking curve. It's not quite as flat as it used to be. However, it is substantially lower than where we were a year ago, as you can see by that green line. So kind of low and steady, and probably will be for the predictable future, although we have started to see a little bit of an uptick in yields in the last couple of weeks. And as always, we have my favorite slide here, the impact of diversification. So as we can see here is that graph on the bottom, that trade-off between risk and return. Obviously, a portfolio consisting of 100% stocks over long periods of time has outperformed other allocations with more fixed income. But as you can see, we also have substantially more volatility, with 100% stocks. So we can see kind of that trade-off, between risk and return there below. And that'll be the end of the market review. Does anybody have any questions or comments regarding that information?
No questions.
All right. So we will go ahead and move to the quarterly review. I think some of you might notice that this format is going to be a little different. So the software that we use to keep track of this has had a major revision and update in the last 6 months or so. I think this is the first review that shows the new format. I think it's a better format. Certainly some of the things are a little easier to understand. The graphics are a little better, but if anybody has any questions on the format or any of the information, please don't hesitate to ask. Another thing that we did start tracking with the new revision, we get a little bit better information now off of from the Blackrock funds. Previously, the performance information didn't come in as perfectly as it does now, but doesn't make a huge impact since these are all low fee, passively managed index funds. But as you can see, one of those is actually not doing quite as well. So that'll be on the watch for the first time. I believe it's the first time we've had anything on the watch, at least for a while. So as you can see down there below, the Blackrock Russell 2000 Growth has not done quite as well. And we'll get into that here in a little bit more detail. As far as general plan overview, as of the Q4, the plan had $11,351,528 in the plan, and that was across 23 different investments. And we do have that one investment, that Blackrock 2000 Growth, on watch here, as you can see. And I think right now that represents about 0.05% of the assets. So not a huge position in the plan. Most of the assets are going to be in the target date funds, which I think is a positive thing for the participants, since those are low fee and certainly perform pretty well. As we go down a little further, we can see some of the other investments. For the most part, no problems with these investments. You can see how they score here. You do see that Blackrock Russell 2000 scoring a 69, which places it in the third quartile. Most of that underperformance is actually going to be due to the returns on the 1, 3, and 5 year performance periods. It is also taking a little bit more risk than the benchmark. So that is also leading to a slightly higher score. A lot of times, I suspect that this will probably be go back to kind of a normal, higher performance, given the nature of these funds. But for this quarter, the performance did lag a little bit, which is a little bit surprising. And as we go further, you can see the ratings of the additional investments in the plan. The target date funds still continue to perform very well, as you can see indicated there by the zeros, which is the highest score available. And we can also see as we go down a little further, the scoring for each. The MetLife score, that score is a little bit higher, but actually that's the scoring on the stable value funds isn't very good for this, so that's not something we're worried about at this point. And a little bit more information for each one of these investments. Just to kind of go over this with the new format and how this works, I'll use that first investment as an example, the Blackrock Equity Index Class 6. As you can see here, it's got the type of investment as well as the ticker if you want to do any more research on your own. For this quarter, you can see it scored a 0, which is the highest score available. And as we go further to the right, we can see how it scores as well as the performance. So if we look at this 1-year performance, it returned 18.43% for the last year. And that little number in the bottom in parentheses indicates where that performance was in regards to other large cap blend investments. So it was in the top 32nd percentile. And if you look over to the, further to the right, you can see the returns for different time periods, as well as where that return ranked in regards to other large cap blend investments. So the 10-year, for example, it's performed 13.69% annualized over the last 10 years. And you can see that's in the top 17th percentile as far as all other large cap blend funds. And then on the right, the very far right column, you can see the net expense ratio, which is the investment management fee for the investment. And that's a 0.04%, which ranks in the top 4th percentile as far as lowest fee investments in the large cap blend space. So a little bit more information about all these. For the most part, everything's looking good. I do want to point out that Blackrock Russell 2000 growth. So that did score a 69, as I mentioned before. And as we move further to the right, it gives you a little bit of clarity on why that fund did not do as well. So despite returning 34.52%, which is pretty phenomenal for anything, that small growth space has actually returned, the median fund has returned 37.5%, as you can see a little bit further below. So that 34.52% was in the top 58th percentile or 3rd quartile for that performance. And so you can see that fund has not done quite as well from a straight performance standpoint. And then you can also see the expense ratio of 0.11%, which is in the top 2nd percentile for lowest fees. So despite being low fee and passive, we still are having a little bit of underperformance in that. So if we continue to see this over the next few quarters, we will most likely bring a recommendation replacement to the committee if that underperformance continues. So a little bit more information about these. Everything's scoring pretty well for the most part. And then you can see, I'll just use the target date 2030 as an example from the TIA-CREF. So those scoring a 0. And if you look at the last 1-year performance, 14.7%, which is in the top 19th percentile. And you look at the longer period of performance of 9.36%, that's in the top 90%. So very strong performance from those. Since the majority of participants are invested in those target date funds, I think that certainly bodes well for participant balances and their performance. So a little bit more information on that. Nothing much else as far as that. And then we also have a little bit more information on how these funds have done historically. So we can see a little bit more information there. But for the most part, everything else is looking good. Nothing on replace for this list. We also do have a little bit more information on this fund, the Blackrock Russell 2000. So if you want to dig deeper into the performance, there's certainly some more information there as far as alpha and Sharpe and style drift, things like that. So with that, that'll conclude the review. Does anybody have any questions regarding the individual investments?
How does the board feel about the new format? I kind of like it. I think it's easier to follow, I think.
Great. That's thanks for that feedback. We think it's a lot better, but obviously you all, it's you all's opinion that matters most. So I'm glad.
Bobby, what do you think of this new format?
I like it.
You do?
Yes, sir.
Good.
All
Anybody
right.
have any
Garrett,
comments?
I might I might ask the the type of stocks in that BlackRock Russell 2000 Growth Index. Um, can you give us some examples of the type or some of the stocks or groups of stocks that are perhaps dragging that down, or is it just happening across their entire portfolio in that particular investment?
So I certainly don't have a list of stocks. So the Russell 2000, there's the Russell 1000, which is going to be the largest 1,000 companies in the U.S. By market cap. The Russell 2000 is the next smallest. Probably in general, you probably won't recognize many of the names in the Russell 2000. Typically the largest 1,000 companies are the ones that most people hear of. Since this is a straight index fund whose main objective is just to track the Russell 2000, it's a little surprising that we've had some underperformance. This is not an actively managed fund. So, generally when you see underperformance is because of an active manager, maybe isn't doing very well as far as security selection. In this case, the security selection is done by an algorithm, and essentially everything that the Russell 2000 that's held in the index is held in this investment. So I think we'll probably want to do, if we continue to see this underperformance, we'll want to do a little bit more digging and probably talk to the portfolio manager for this index fund. But in general, with these index funds, there's not a lot of, this is a straight index fund.
Sure.
That doesn't really manipulate the algorithm very much. It's really just what we call cheap beta exposure. It really just tracks the index. So I'll have a better answer for you the next time. This kind of caught us a little bit by surprise with the BlackRock ones, but next meeting, I think we'll probably want to dig into this a little more if it is still on the watch list.
And I agree. Getting into these specific stocks probably doesn't make any sense for us. But if there's certain sectors that are represented there, excuse me, and maybe that's not. Maybe that doesn't have much to do with decision making that we would have. But I'm just kind of curious. With others doing so well, what are there certain sectors or is it energy? Is it agricultural? Is it real estate? I wonder if there's a sector in here that's standing out as a reason for the performance. I don't expect an answer now, but yeah.
No, these are great questions. If I were speculating, and I'm just kind of giving my opinion here, because I haven't had a chance to really look into it as much as I'd like. But with these index funds, there's a little bit of underperformance due to people front running the index. So essentially these indices release, what companies are going to go into the index or what companies will be leaving. There are speculators and traders out there that essentially can predict which companies will be added or removed from this. And so one of the problems in running a straight index fund is if let's say you have the S&P 500 fund, if there's a company like Tesla that's about to be added to the S&P 500 fund, what happens is before the announcement is made official, you have a lot of speculators driving that price of the stock up because they know that it's going to be added to the index, and they know that once it's added to the index, that all the institutional funds are going to have to purchase it to some extent. So sometimes that transition, when companies get added or removed from the index, there's people out there who make money on that type of information and kind of front run that information. It's not illegal, but it's not also great for just straight performance. There's other index funds that do a little bit to manage. Dimensional funds, for example, they actually do not purchase, the day the new index weightings come out, they don't, they are not obligated to purchase those exactly, which kind of helps mitigate some of that risk. But there is certainly in volatile times like we've had in the last year, there probably has been a lot of speculation and movement as far as companies going in and out of these indices. So I suspect that probably has something to do with it, but I'm just speculating at this point.
Thank you.
That certainly can, and that happens almost with every index. Usually around the third or fourth Friday of June. That's pretty much when they all reconstitute. And that's part of it. I think with BlackRock's a great company. I think they may have just some timing issues. That sector's been beaten up because the small cap has always, for the last 100 years, beat the big caps. And for the last 10 years, it hasn't done it. It hasn't had that dimension of value. But it did pretty much the last 2 quarters. It did. It took off when the market started taking off again. You saw it was up 33%. And so you're seeing people take money out because they're looking in the rearview mirror. And then all of a sudden it takes off and they start reading it's taking off. And so they start throwing money back into it. It's very difficult for money managers, especially an index manager, to manage that because they try to keep very little cash. They don't have a lot of trading. All of a sudden trading starts. Now they got to start selling stuff. They sell their good stuff because they don't want to sell their dogs. So they sell their good stuff so they can meet liquidity changes. And then all of a sudden it takes off. And now they got all this liquidity again. They're trying to reinvest it. And so that's active people playing with indexes. So that can happen. But, you know, we're focusing on a real small part of our portfolio, very small part, because it's the only one that's got yellow. The rest of our portfolio has greens. I mean, this is just phenomenal. So we don't want to stay too focused. I don't mind leaving it on the watch list, but it's like, you know, it's not a big deal yet. If they start continuously underperforming, you know, maybe we'll look at something else. But again, we're looking in the rearview mirror. We're making all our decisions on stuff that's already happened. Mm-hmm. And so I'm always afraid of trying to do a prediction, looking at historical data on what's going to happen and move. For the ones that stay in the target dates, they're good. I mean, that's just not going to change. These are some of the outliers, but it's not. I mean, we get focused. You always focus on the bad news. Okay? This past weekend, we didn't hear about all the United Airlines that took off and landed. Nothing happened. We just heard about the one who the engine blew up on. Mm-hmm. So, you know, we only focused on the bad stuff right now, and that's okay. That's our responsibility to look at it. But in the bigger picture, this whole portfolio for all of our employees is just doing phenomenal.
Mm-hmm. I would certainly agree with that on multiple points. You know, just the fact that we're straight index investing is at a low fee. You know, this is certainly not a plan I lose much sleep over at night. And just by the nature of these index funds, you know, there might be some times where you have some friction, as Mr. Ferris described, as far as, you know, a lot of money kind of moving in and out and making things difficult for index managers. But over longer periods of time, you know, those index funds typically, you know, will outperform. And, you know, the fact that we're only paying, you know, less than, you know, 5 basis points for the management, you know, year over year, that's not going to, I think the performance is going to be on track, I guess.
Very good discussion. I don't know if you pointed out, but just to mention to the board that our assets are at $11.3 million as of this reporting period. So that's good. The fund is growing.
Anybody had any, I know I probably don't ask this enough, but, you know, has there been any feedback from any of the participants that anyone's heard of? Does anybody, you know, be happy with the performance?
The only thing that I had asked you to do, and I think you did it, was when the pandemic started, just getting information to the participants saying, don't make any changes to your allocations. Yeah. Leave them as is, because if you did, they made money during the pandemic because they were buying when there was a drop in the stock market, and so it's picking up now.
Yeah, I think that I think that's a point that I probably should have circled back to, because, you know, if people had kind of let their emotions dictate their investments in that period, I mean, look at how much worse off they would have been over the last you know, few quarters. I mean, look at the performance for these target date funds. If somebody had pulled all their money out and went to a stable value fund during all of this, I mean, they would have missed out on one of the best couple quarters in market history. So I'm definitely, I hope that most of the participants stayed the course. Judging from the plan, it looks like they did. So that's great news. But, you know, that certainly needs to be the message for the participants is please don't try and time the market. Stay the course. This is long-term. This is a long-term retirement plan that, we don't need to worry about the ups and downs, from one week to the next.
And just as an FYI, cities that provide 457 plans with no contribution to the employees are not responsible to act as fiduciaries for the plans as well. So we reached out to TCG and hired them to do that for the 3 funds that we provide, which is ICMA, PepsiCo, and Nationwide.
Nationwide, yeah.
So we're going to be doing that. We started the process already, so we're going to have to form a committee pretty soon to do that. So
That's a good move.
Yeah, the nice part about this plan, it'll be very interesting to line up the 457 to the 401A as far as fees and performance, and I think there'll be some good improvements that come out of that comparison, showing the difference between low fee index investing versus some of the higher fee products that we see, the insurance products that are currently in there. So looking forward to making some good changes for those folks.
Oh, so am I. Because I'm in that one too. Okay, we've done review current plan assets and participation by TCG. Let's move on to item number 5, review and approve recommended investment allocation and evaluation. Is there a motion to approve?
Motion.
I hate to make good. Second.
All in favor, say aye.
Aye.
Aye. Motion carries. Schedule the next meeting. I'm sorry that we had to cancel the one from last week, but
Before you move on to that, I just want to make one comment that I do want in the minutes. I'm still concerned about the loans that are coming out of this. I think we're over $500,000.
yes, we are.
Where it sounds good, and I know that there was some political pressure to give in to do this. People are really mortgaging their futures, and it's fine to be young and poor because you got human capital you can trade for financial capital. When you're old and poor, you can't do that. I have people that come in my office, once a month or so, and they're 55 and they think they need to start saving for retirement. And I'm just, I don't say it this way, but I mean, you're going to be a Walmart greeter if your health stands. I mean, I can't do anything. And so those that are borrowing from their portfolios are really, when they go to retire at 60, 65, or 70, whenever they do it, it's really going to be painful because just being old and not having this money. The portfolio since 2007 has performed greatly. I mean, it's really been good. They own this. It doesn't die when they die. And so this is stuff that they can have intergenerational wealth transfer for and keep going so their kids start at a higher level when they start saving, and grandkids. And we haven't had inflation for a while and people tend to forget it, but it's going to come back. And it's not going to be pretty when it comes back because it's going to be gone. We've been selling all the debt to China and we've been pushing out there. When they quit buying it, the inflation is going to pop up here, and your dollar's just not going to buy as much. And so you need lots of dollars when you retire to live well. And so that's my only concern. There's probably not much we can do about it other than a little counseling when they come in. Say, please don't take any more than you need. Please don't use it to buy a new truck. And and show them the charts. There's no better place to be to grow wealth than in the market. For the last 100 years, there's been no better place. And so moving money somewhere else, unless it's really a dire emergency and they can't get money anywhere else, this is okay, but it's going to be painful if they don't get it paid back and get back into their account. Other than that, this thing is working phenomenal.
Yeah, I agree.
Bobby, I have a question about a comment that you just made there with inflation going up. To what degree does money in the market, I'm not talking about necessarily fixed return type investments, but general stocks, to what degree does that compensate or partially erase the effects of inflationary loss of value?
Well, I think the market is about the only place. Real estate will keep you about even, maybe a little bit better than inflation historically. I don't have a crystal ball for going forward. I just know what the market's done, but the markets over time have beat inflation substantially by 400 or 500 basis points. And so that's because companies like Coca-Cola can reprice their Coke for inflation. When I was in Austin at the University of Texas 40 years ago, I could go anywhere on campus and buy a Coca-Cola for 15 cents. Today it's $1.25. Coke's the same. It's just your dollars are worth a lot less. And so that's one example that I give to people, because I can't compare cars or something, because cars have changed so much in 40 years, but the Coke is a Coke, or a grape, apples. And so you need to have a lot of money. So you look at what are the investment vehicles that are going to give me that. Gold won't do that. Real estate maybe will do that, but real estate takes work. I mean, it's not like with the stock market, you got millions of people every day that go to work at 8, come back at 5, and you get some of their profits, and you don't have to do anything. Real estate, if you get in there, you have a duplex or something, you got to evict people, fix it, argue with the appraisal district. There's just a lot of work that's involved. I didn't mind real estate when I was younger. At 64, I have no interest other than real estate that I use. So we're going to have times and where the market has historically just yielded 10% year in, year out. In the beginning, as inflation gets bad, as companies are trying to figure out if they can make adjustments in their prices, you're going to see the market get compressed a little bit. But over time, if I'm going to try to do my hands, if this is inflation, the market's going to stay ahead of inflation over time. In the beginning, when inflation takes off, like we had in the mid 80s, you're going to see the market dip down under it until they can reprice. And once they reprice, then they're back to the races again. So it's just during those times, like in March of last year, and when we see the market dip again, you just have to have people to, you hold their hands or talk them off the ledge and say, don't leave the market. Look at the history. You don't look at the parade through a knothole in the fence. Santa Claus is at the end and he'll get here. Just don't leave. And that's what we earn our money, we think, when the market's down. It's a behavioral finance stuff. People just start getting scared. Right now, everybody's a genius. I mean, everybody, no matter what you're buying, all those guys on Robinhood are making all kinds of money, and they just think this is easy. It's going to come to a screeching halt, and it won't be pretty, but that's okay if they have a coach that will keep them on track. All we have to do, just like the people that got scared in March, we went down 34%. Okay? If you just power through that, we're way ahead. The people that were adding, like Gabe said, during that time are way ahead of the market on just the ones that sat still. Yeah. But I know of no other investment vehicle that will keep you ahead of inflation than the market.
And so I think that goes to your comment we heard before about maintaining as much of your portfolio in the stock market as opposed to fixed income. And I know a lot of the plans that we have for different ages are blending in a whole lot more fixed. So I would imagine that takes some strategy, but I think the point about beating inflation, if that is indeed going to come because of all the borrowing that's been going on, the market seems like a place where you can have some long-term hope to beat inflation, where fixed is not going to do that. Anyway,
fixed certainly won't do it near term, because we're watching the interest rates go up. Fixed just had a great run for a decade. And but it's going to dip down. The only reason we know that really you're not going to make a lot of money with fixed income, we only blend that in as a shock absorber, and that's to keep people in the market. If you're at a 50-50 mix and the market goes down 20, you only go down 10. And so by compressing those amplitudes of volatility in the market, we keep people in the market. So ideally, people would be in 100 zeros and just hold their nose and go. But I've got to blend in some fixed income so they have a shock absorber in it. So yeah, I went down a little bit, but I'm okay. I'll stay in, because once they call me at 2 a.m. and want out, it's too late. And so I spent a lot of time educating people in the beginning so I don't get those calls. But those calls came to other investment houses because the market sold off. And so that was coming from somewhere. It just didn't come from our clients, and probably didn't come out of TCGs, because they have very similar investment philosophies that we do.
Good discussion. Thank you.
Mm-hmm. I felt like I was back in one of my economics classes there at UT Austin, Bobby. That was great.
I'm very monodimensional. I can do this and fly airplanes, and that's it.
Okay, schedule our next meeting. We can either go back to this date or when we had the meeting we're supposed to have prior that we had to cancel because of the ice storms. So what does the board want to do?
I think we're pretty consistent on the third Wednesday after the
Okay.
quarter, aren't we?
That would be May 19th. Would that be good for everybody?
I'd have to go look at my calendar real quick, but I'm sure it's fine. That's
Okay.
on sale.
Good for
But-
me.
If it doesn't work out, Bobby, just let us know. We'll get another date.
Okay. That I'll scroll through. Did somebody say the date?
It's 19th at Wednesday, third Wednesday, May 19th. 9 o'clock or 11 work better for you?
Nine's fine.
9, okay.
Yeah.
So let's plan for May 19th at 9 o'clock.
Okay.
Barring some major disaster.
Yeah.
So Gabe,
Okay,
that
well-
does, if we're still doing EOC meetings, that does cut into the EOC meeting on our Wednesdays. Hopefully we'll be done with that by, in 3 months, but you might have a better feel for that.
Do you want to adjust the time?
10 o'clock would be fine, or
10 o'clock would work
Yeah.
as well.
10 works.
Okay,
Good.
okay, great.
Thank y'all.
Thank you,
All right.
everyone.
Thanks, everyone.
Have a great day.
Bye.
Have a good one.
I know.